Tuesday, the 6th of March, 2018. This is your daily Forex trading strategy session. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but always stay small, stay humble, focus on the long term, and money cannot afford to lose. Bon dia, Pete. Hi. My name is Wayne McDonald. I am the Chief FX Market Strategist for TradersWay.com. Thank you very much for being a client. Do these sessions Monday through Friday here at Forex.Today at 7:30 in the morning, which is a couple hours before it really heats up in New York. It's also approximately London lunch, and it's a great opportunity for our community of currency traders to get together. Thank you for being a client, and if you have not visited TradersWay.com, please do so. Give us an opportunity to earn your loyalty and respect. I don't know what Windows 8 that was. This Friday is non-farm payrolls. I will be hosting a webinar called Trade Non-Farm Payrolls Live, which I've been doing for 143 months in a row. So I'll see you over at FX Street for that event. But go ahead, open your demo account today, and I'll see you then as well. Life is great, life is grand, life is good. Oh, right. Where's the dollar strength, Mickey says? Well, North Korea is looking more subdued. That's risk on. Trump advisors are talking about him backing down on his trade barrier stuff. And as you probably know, the head of the Japanese central bank has also kind of stepped back a little bit on the talk about ending quantitative easing in Japan. All of that means dollar weak and Japanese yen weaker. That's what I would assume right off the bat without even looking at a chart. Yeah, that probably happened, didn't it? Well, that's how it goes. You can't win them all. Why don't we start with that then? Joe or Joe says, "Hey man, you broke even on this sucker." Yeah, that happens. So yeah, I sold this actually Friday. I think I sold it, and this move up in here, I got knocked out at break even because I was short just below this dotted line. And I'm like, yeah, which is good because I think this might have been enough to knock me out of, at a bigger loss up here, right? So I lost nothing. I had the opportunity, and son of a gun, yeah. But you know what that means, Joe? You're going to have to add some money to Wayne's whiskey and cigar fund. Next month, yeah, next month. All right. So anyways, that's funny, right? So what am I going to do? I mean, I'm managing my risk, and there was definitely dollar strength going on in the world. And of course, 24 hours later, it's all different, right? Oh, lost that. But maybe psychologically it validates the validity of the trade in of itself. Maybe we walk away with something, even if it's emotional. That's probably worth more in the long run, right? So anyways, boo-hoo for me. I mean, I can still catch it, right? Oh, Jimmy got knocked out at the high spike. Yeah. I mean, you know what you're supposed to do, and I know that's a big supposed, but you know, your stop should be about here when you take the trade. So we all messed up because this whole area is the sell zone, right? So your stop is supposed to be above the sell zone. So my bad too. Use the other pivot. So anyways, that was oh, I see. No, you're right. I did draw it wrong. Sorry about that. Yeah, that's the sell zone. All right, my bad. But if you go back to last week, and maybe that's what this was. Okay, last week you can see I had that as a sell zone. So anyways, yeah. But your stop should still be above the R, right? What holds this down? Resistance. That's R1, so your stop should be just above resistance. But well, I didn't do it, so what can I say? Woohoo. Let's change this. What do you think? Is that a 618 Fibonacci retracement? Faux show. Now, one of the things we talked about yesterday was even though it said it, I think we were on a 4-hour, even though it said it, like this was set up for a rally, right? Remember talking about that? And I'm like, but I kind of would like to see a double bottom or a reversal pattern or something. I don't want to bet against it because it's clearly 21.55 down. Is that right or not? That it was possible, it was even plausible, but you shouldn't be too quick or too aggressive, right? And I don't think we even talked about the 618 larger macro. Okay. So that's interesting. You see how it did do a higher high? I mean, obviously, this move here is the most important. Okay. So the key to breaking this down, let's see, change the color to blue. All right. This tells a bull up because it tells a bear to stop selling. Both are important, right? Okay. Both are important. Bears are supposed to get out, and bulls have the opportunity to get in. Okay. And then Monday swings around, and this is the pivot point. Right. That's the, I don't know. I don't have a cool name for it, a power pivot. That's the key one for bulls, right? Not the one lower, and not even the one higher. Like that's the key one. That's the one you want. So it is there for bears, or sorry, for bulls. And a bull should then, you can wait for the double bottom like we talked about yesterday, which still could happen, But a bull could also do something like this, right? In that case, it's a breakout retracement type trade, right? Now, obviously, the RBA stuff is what made that move, but it's still technically there. And if you were a bear on this, okay, well, this is the really only the swing. That's the only swing short. So you had that like pre-news and all that kind of stuff. So I don't know. It's interesting, right? It's not an easy trade, but it's plausible. Okay. Support, breakout, pullback, gone. This is the most ideal sell pivot, by the way. I would assume whoever was selling down into this is going to want to try to sell into that. So I'd pay attention. Doesn't mean they will, but that's what they were thinking about yesterday. Things might have changed, right? They may stop thinking that way. But wouldn't a bear take a look at that? Okay. Do you think a bear would give up because there was a 618 Fibonacci retracement? Right? They saw this. They saw this. Question is, would they do that? So I would assume they're going to take a shot. We don't know if they'll win, but I think you'd be a fool to buy it now. Cool. Here's another boohoo trade. We did talk about it since about Thursday or Friday, that this was a zone where, hey, even though we haven't seen Canadian dollar strength in quite some time, that could take effect here. Instead, it went to this. Now, does anyone believe that this pivot point here was important to the formation of the double top? Was that part of people's trade plans? Or is that just simply a random walk? Okay, Brooke took a shot there. So if it's not random, that was part of the market's technical analysis, then they're targeting this pivot. Luckily, Uncle Wayne has already identified this area like a week ago. So who knows? The other play is it's all nonsense, and we're going to get something like this or something like this. That's what bulls would be thinking, right? Okay, this would be definitely of interest to a bull. The velocity of this drop might scare them out. In that case, they'll probably set it up down here off the central PP. No. Now, John, for the reasons I explained at the top of the webinar, doesn't seem irrational to me at all. Green light, macroeconomics. Everyone jumping in, making money. Getting out of the trade because of fear is irrational. I don't remember drawing this. I don't remember if I did it before or after. It looks like I drew it before the big rally here because it's not very good. Looks like I did this Thursday of last week, right? So I think we were here and I suggested double bottom, higher high kind of move. Well, that being the case, the double bottom was a plausible entry, right? This pullback is a plausible entry. A higher time frame move is a plausible entry, and I'd call it like that. Even on even yet another higher time frame, it's going to look like this. It's all the same trade. Okay, it's this retracement. It's all the same trade, whether you buy this one, whether you buy this one, or whether you buy this one. They're just different time frames. 1 hour, 4 hour daily, right? And off we go. So now the next part of this would be up, 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 down, 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 up, 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 up. Huh. Looks like it wants to make its way up to the next gray zone, huh? We got to get through this price and we got to get through that price. And I hope you understand that if you buy it now, you're foolish. You could, the only dumber price would be to buy it here. You say, well, it's not the dumbest price to buy. It's the second dumbest price to buy. I'm trying to remember the context of this conversation, but you can see I've gone to great lengths to identify this as support and this as resistance, right? So it feels to me what I was trying to say in the past is that there's a high plausibility of this, right? Now, the interesting thing is once you start truly planning your trades and doing your analysis, you'll find that you leave yourself notes like this. I don't actually remember I kind of remember doing it, but I don't remember like going step by step by step. I don't remember the conversation, but I do remember doing it, especially now that I back out even further and see the range. And what it made me think of is I think it's important because I leave myself notes like this, like memento. You wake up, you got tattoos all over your body, you got Post-it notes all over the wall. Buy gold at 113.06. You know, you're like, what? Shaw depends on what your trade plan was. If we're talking daily pivots and you're in something that's set up on a weekly, you know, then shouldn't you stay into the weekly? I mean, that comes down to your strategy. That right from the get-go, it's strategy. Okay. So if your chart is set up on a 15, then you're only going to be in it for 2 hours. If it's set up on a 4-hour chart, you could be in it for 2 days. Could be 2 weeks. Okay. I mean, look how easy it is now, right? Looking at it this way. Would you agree that that looks very straightforward? The support resistance areas that I have here. There's one, here's the other. Right? Very, very easy if you're doing your analysis. Was this the conversation where I said support holds 100% of the time? It'll always, always, always hold. Always hold. 100% of the time. Unless it breaks. It might have been that conversation. Was that euro dollar? All right. All right, so we got to go back to previous conversations here. I know you hate when I do this. I think repetitiveness is important because we're trying to like create muscle memory, right? We have a drop into a take profit zone. Our assumption is bears will stop selling and bulls maybe have the opportunity to buy. Then I have this triangle here, which tells me, I explained to you that this high is higher than that high. Then I'm sure we talked about something like a 1, 2, 3 pattern, which would have you look at a Fibonacci retracement this way and then long, which then sets up a retracement trade, in particular back to the 21. Then it makes yet another higher high. So then you should grab your handy dandy notepad, oops, and you look left, and you have a new buy zone. So you would look for something like this. Cool. If you were a bear and you were against this, and you sold up in here, maybe even tried again up here, good job. Job well done. You didn't make any money, but you did your job. Okay? If you're a bull, these are your buying pivots, right? And if you're a bear, this is your selling pivot. And if you did your job, whether you're a bull or a bear, if you did your job, one person had the opportunity to make money and didn't. The other one had an opportunity to make money and did. And if you did anything besides those two things, you had a very high opportunity, a high likelihood of losing money. But I look at this and I just see the 10-year T-note falling, which means rates are rising. It's all very good. I'm all very happy. When skies are gray. Here's the 1, 2, 3 here. There's another one there. This one's a little more tricky But like we said yesterday, there were only two likely plausibilities: a buy zone, right, or a sell zone. I'd even accept this as a sell zone. Oops. We call this fib wars, right? I think I described that to you, that if you're trading in here, you're a pig, right? Yeah, okay. So that reemphasizes a message I've delivered in these webinars for 15 years. Be a bull, be a bear, or get the hell out, right? And there are clearly bullish areas here, and there are clearly bearish areas, right? This was a pretty clear bear move. Look, if you look at the role reversal, right? If you look at this setup, this is very obviously bullish. You just have to be like one or the other, and it's the mediocrity that kills. The death by 1,000 lashes, right? Death by 1,000 lashes. By the way, quick question. Did anybody sit down and draft a PowerPoint slide, one slide, put down whether they're a bull or a bear on one asset, one currency, or one commodity, just like dollar, and give 4 or 5 reasons why they're bullish or bearish on that? Yeah. Wrote a full essay. That's interesting. Cool. So Shah says would have preferred for it to fall. It doesn't matter. What happens on the chart? Oh, I mean, it does matter. What matters, though, is that you have a bias. Because then, once again, when the market agrees with your bias, and that'll come and go, as we just saw. Dollar was ripper strong, suddenly dollar's ripper weak. And we talked about that yesterday in regards to the stock market, right? But anyways, so when the market happens to agree with your bias, you'll make more money than otherwise. And when the market disagrees with your bias, you may not get very many setups. Your trading will slow down. You might get some shots like you can see on these charts I'm showing you, but you end up kind of breaking even or picking up crumbs. And you're like, wow, this just ain't working. Oh, and Barry, what are your reasons? Too much to type, I suppose. Too open-ended of a question. Never mind. It'll take too long. Never mind. I'm a dollar bear, though, right? When did I announce that? When the Fed tapered. Wasn't even the end of quantitative easing. It was the beginning of the end of quantitative easing. Yeah. And the beginning of quantitative easing made me a bull. But actually, it was before all of that, really. Really at the height of the crisis. That's when I realized that currency trading is very much related to the bond market. So like I said, I'm looking at this, and I look at this and I think of the yield on the 10-year T-note rising, and that this has an inverse correlation to prices, treasury prices, right? That's what I said that maybe 15 minutes ago, right? And that's what I meant. 10-year T note chart. I wonder if good old CNBC will do it for us. La 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 la. And if your bird can't fly. Okay, trying to zoom in here. So that's the last 24 hours. And let's move this to like a 15-minute chart. There's a little bit of a relationship, I'd say. Okay, this is the yield on the 10-year T note since yesterday, so yesterday morning. So yesterday it started out fairly flat, right? And then right around 10 or 11 in the morning it took off. Check that out. Yesterday at 11 in the morning. Yesterday at 11 in the morning. Ha! 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 What? Sweet, right? So this is the exact opposite of what you've been taught, though, right? Think about it. What were you taught? If interest rates are higher, if local interest rates are higher than world rates, then the currency will appreciate. I don't know if that's over anyone's head, but has anyone been taught that? You had a class, you read a textbook, you heard some person on TV, and I'm showing you almost step for step that that's just incorrect. What's the difference? Yeah. Well, what is the difference? Let's help you become an expert. Why are they only partially right? No, I wouldn't say that, Ted. The reserve currency. Thank you, Chuck. It's because it's a reserve currency. So when business globally, right, when business globally improves, that business happens to be done in US dollars, and the supply of US dollars globally becomes more available, so to speak. Okay, they're doing business in dollars. They're not buying US dollars from the United States. They're using dollars already floating around, this liquidity, this world of US dollars. I mean, business is floating on the ebb and tide of US dollars outside of the US. And you can see here, or you can't see here, on the other chart, on the 10-year T note. Hang on, let me bring that back up. How does, let's go back to, yes, the way I had it. Or how do we do this? 6 months. Okay, good. That's a great one. Okay, 6 months. How do you get interest rates to go from 2 to almost 3% in 6 months? I mean, what is actually happening to make the interest rate rise? It's not law. It's not like the President of the United States comes out and says, interest rate on 10-year T-note is going to be 2.9%. What is the mechanism, the economic or financial mechanism? What's actually happening? Money goes to the stock market. That's a causation, not a, okay. It's not open market operations. But what's making the interest rate move? Bonds. Thank you. Well, in this case, it's not bonds. It's actually treasuries. The difference between a bond and a treasury. A bond is a corporate loan, per se. And then a treasury is when you're loaning money to the government. It's specific. Because, I mean, in this case, a bond would be the wrong answer. It's a treasury. Because when global economics look bad and business seems doomed, you use your money, in particular foreigners. This happens to Americans too, but if you're a foreigner now, you decide, I'm going to buy a safe treasury guaranteed by the US government. And in particular, in the reserve currency, because I'm going to need that currency in the future, hopefully, and there's all kinds of other risks I have to avoid. So I am going to buy the 10-year T-note. When most of the world is thinking this way, then think about what happens to bond prices when most of the world are competing with each other to buy these assets. Think of an auction. There's 100 buyers eager to buy, but there's only one thing up for auction. Price will go up, correct? They'll outbid each other. Well, then in reverse, so think of a loan now. There are lots and lots of banks, right? There are lots and lots of banks willing to lend you money. They're all good banks, all similar customer service and all that kind of stuff. You don't even really care which bank now. How do you choose? What's the best, most straightforward way of choosing which bank to take a loan from when they're all essentially the same? Let's say it's a mortgage on your house. No, they're all essentially the safest. They're all the same. Like what I'm trying to say is, well, whatever, they're the same. It's not a risk issue. Yeah, the lowest rate. Okay? So when there are buyers all around the world trying to loan money to the US government because they see it as, well, it becomes an instrument, right? That debt instrument is an asset. You can say, well, the US government owes me $1 billion. Right? That's an asset, right? Now you have a piece of paper that says you loaned the US government $1 billion and they're going to pay you back in 10 years, and every year they're going to pay you 2.897%. Okay? Now, when the whole world is competing and buying these assets, the value of the assets go up because everyone's trying to buy. And because everyone's trying to buy it, the government can pay less. They could say, well, right? I don't have to pay you so much because I have so many people trying to loan me money. I don't have to pay a high interest rate. I can pay a lower interest rate. So as prices go up, interest rates fall. So here's my point. Get rid of like the standard operating procedure you were talking about, interest rate differentials and stuff. When you're looking at global macroeconomics, when things are bad, foreigners around the world that do business in US dollars want to take risk off the table, because remember, things are going bad. You don't want risk when things are going bad. You want to protect your money. So in this case, you say, well, I'm going to buy a 10-year note. And if everyone's thinking about that, right, then prices of those assets are going to go up and the interest rate will go down. Well, in this case, interest rates going up, clearly, day after day after day after day for 6 months. Interest rates going up. So conversely, what's happening? Interest rates are going up. What's happening to the bond market? Down. Great. Prices are falling, right? Interest rates are rising because now if the government wants to borrow money, now they're the one competing. They're like, well, how about 2.5%? And people are like, no, I don't want to lend you money for 2.5%. How about 2.8%? They're like, no, I got inflation risk, I have duration risk, I have opportunity costs. That's just not enough. So now they're like, how about 3%? And all of a sudden people start showing up. They're like, okay, 3%, I'll lend you the money for 3%, right? You see that? So now, we're looking at this chart of the 10-year T-note, and we see now if there are foreigners selling their 10-year T-notes, they're bringing their money home because they're foreigners. So what are they doing with the US dollar? They're selling their US dollar. Well, they're trading it. They're trading their US dollar for their local currency. See, they bought the US dollar to buy the 10-year T-note. So when yields are falling, the dollar's strong. The opposite of what you were told. Assuming that the foreigners are buying it, right? And then suddenly, if foreigners are selling their bonds, they're also selling their US dollars and they're buying their local currency back. Right? You see that? So I've been telling you for years that things are good. And in particular, I did a big thing back in January or something, wasn't it? Early January. Now, we're in like almost the middle of March. I'm like, this is when you really should start looking at things like buying exotic currencies and all that kind of stuff. But macroeconomics seem really good. And maybe you should be selling US dollars, assuming global macroeconomics are improving. And this shows an example here. But I look at this interest rates are going up, which means the bond market is falling. Or sorry, the treasury market's falling. And if it's foreigners selling, because they're not looking for a safe asset, they're actually looking for risk because they're looking for return. Return is a function of risk. So they're investing their money somewhere else, maybe business projects and all this kind of stuff, right? So they're like, oh, all right, I don't need to lend the government 3% because I'm trying to do some business projects that'll make me 10%, right? So they sell their treasury. Now they have US dollars. They trade in the intermarket or interbanking system. They convert their US dollars into some foreign currency, which means demand for the foreign currency goes up, but the supply of US currency in the world market goes up. And what happens to something when the supply goes up? What happens to the price of something when supply goes up? It reduces price. Yeah. right? And it's a supply and demand curve. So you could even do this quite quickly. Quantity of money, price of money, value. You could do it, right? So let's say, well, you got demand 1, right? And you got supply 1. Okay, so if it's going this way, quantity is rising. So we'll increase the supply globally. So we go from the original quantity, which was Q1, to the original purchasing power, which is P1, to the new one, which is Q2. So an increase of US dollars, shifting the curve to supply 2, in the global market will actually reduce its purchasing power relative to others, right? And what else is happening? You could even say demand is shifting from D1 to D2, right? And it could fall even further. So we went from here to here to here. And the difference is, short term versus long term. Y versus Y bar. Anyways. That's hot, right? That's hot. Cool. So a lot of what we do, or how about this? Because it doesn't have to go that way. A lot of what I do comes from that I'm a businessman. All right? I've been an entrepreneur as long as I can think of. I mean, like 8. By the time I was 20, I ran an organization of 3,000 people and sat on a board of directors in New York City with the likes of George Soros and many other senior executives at giant Fortune 500 companies. Then I went to Silicon Valley, right? And so on and so forth. This is how I think. So I bring that to the table and I say, well, why does all this money flow around? Why does it move across borders and stuff? And I tend to look at it as a businessman. So I look at it from a macroeconomic point of view. Supply and demand, supply and demand. And so that's how I interpret that. The supply of money globally and the demand for safety, or I guess in reverse you could call it the demand for risk. Risk on, risk off. And that is a lot of my thinking. Doesn't mean it's the only one, but that's definitely how I think. Yeah, Emilio it talks about, where we're going. Well, that's for the market to decide, right? But we know based on simple, historical analysis that there's room based on real rates and real inflation levels and all that kind of stuff, right? We are not at the historic norm. 3% is not the historic norm and all that kind of stuff, right? So we'll find that out over time. Sure, Ted. So, anyway, phone turned on. Where did you just go? How funny. My video went off, my mic went off, and now you're back. Yeah. So if you follow these three rules, right? So, anyways, I'm gonna put this on YouTube. We'll do a rebroadcast. If you're watching it there, give it a thumbs up, give it a like, subscribe, all that kind of stuff. I hope you're enjoying that new feature. So I'll get that going ASAP, and otherwise I'll see you tomorrow. Peace on earth. May the pips with you. May our profits be above average.